Good afternoon. Thank you very much for coming today. It's nice to see a full set of seats. I'm going to ask you some questions today about Turkey, and I'm going to give you some views about Turkey from an expert whose first day in Turkey is today. So please don't imagine that I know what I'm talking about. I'm going to do my best to give you some inside information about the way cross-border global investors think, and then make some speculations about the place of Istanbul and Turkey in that context, which may be wrong. The first thing I'd like to say is that global investors love to carve the world up in what we call a top-down way. So institutional investors think about strategies for investing top-down, beginning with a continent or a regional grouping of countries. And they're driven to invest somewhat in line with these percentages. So if somebody says that 30% of the world's real estate is in the US, that becomes a benchmark for investing. If somebody says that 30% of the world's real estate is in Europe, that becomes a benchmark for European real estate. Now, my immediate challenge for Turkey is, where is Turkey on the chart? Do we know? And do institutional investors know where Turkey's on the chart? And I have to say, I'm not completely sure they do know. They know that Turkey is a wonderfully exciting country, but they don't really know where it fits in their top-down allocations. So I'll come on to that point in a minute. Now, where investors think about putting their money is, first of all, buying buildings. Secondly, buying into funds. And I'm going to try to sell you the idea that there are two types of investors, two types of funds. And it's an exaggeration, but I hope it makes a point. In the world, there are low-risk, core property investors who are primarily trying to diversify their risk across the world of global real estate. And then the second type of investor, who used to be called a vulture fund, and I don't know whether the English word vulture is something you recognize, but it's a bird which eats dead meat on the road. A very unpopular term for people picking over the carcass of a dead market, now called opportunity funds because it sounds better, but they're still doing the same job. They're looking for cheap real estate, higher risk, and they will go where they think the opportunities exist. Then we have the public real estate sectors, which tend to be domestic markets. So the Turkish REIT sector is going to be dominant in Turkey. The UK REIT sector is going to be dominant in the UK. And then we have a boom, a real boom in debt investing. So that this year we think there have been at least 80 debt funds launched in Europe and half as many equity funds raised in Europe. So debt is the big new fashion. Now these private funds, be they core funds or opportunity funds, be they low risk or high risk, boomed in the early 2000s to the point where they're now controlling as much capital as the entire listed property sector in Europe. So this market has started from a very, very slow start, a very small beginning, but is now as big as the listed quoted property sector in the continent of Europe. We know of at least 1,000 vehicles with an asset value of something like $2 trillion invested across Europe. And it's about 15% of the European property market is held in these structures. Now these structures are interesting because they tend to be cross-border. Most of them will take capital across markets. Here's the core and opportunity background, the low risk, high risk. At the bottom of the scale we have low risk structures, low leverage, return targets of as little as 5 to 7% total return, and this is including capital growth. And at the other end of the scale we have the opportunistic vulture funds looking for returns of over 15% and borrowing as much as 75% against those assets. Now, forget the ones in the middle, but the world is splitting between the left-hand side and the right-hand side. And investors who turn up in Istanbul will be core investors or opportunistic investors. And you will be well advised to think about who you prefer to deal with. Okay, so that's the background, and now I want to talk about three things. So firstly, what's going on in Europe? Who's raising money? Then, secondly, who is giving them money to invest? And then thirdly, how do I think Turkey might fit into that picture, remembering that this is my first day ever in Turkey. So, a health warning for part 3. The first thing, if we look at European investors, these are British pension funds, Dutch pension funds, German insurance companies. These organizations are generally low-risk investors. So that if we look at 2013, the majority of the money being invested is in core real estate, low-risk investing. We also see that the peak of the market was in 2006, 2007. There was then a tremendous decline in money raised, and that's now building back up again. So we are now starting to see a turn up in money raised. So 2 things from this slide. The first thing is that European investors are core low-risk investors, and secondly that there is now a rebound in money being raised. Same thing for the US market. Notice that there is not a lot of blue on this slide. In other words, not much core real estate. The US investment market is focused on opportunity, high risk, high return. So organizations like Blackstone will come into the Turkish market looking for 15% returns rather than the German insurance funds or the Dutch pension funds, who are generally looking for core returns. And remember, if we go back to this slide, the core return that these organizations are looking for is 5 to 7%. The return the opportunistic funds are looking for is 15%. Possibly that's why the US grows more quickly than Europe. So 2 things from the US slide. Again, there is a rebound, and the rebound started earlier in the US, so there is a lot of US money now being raised, and the majority of that money is for high risk, high return investment. Now the markets are also splitting between low risk and high risk, and the last 3 to 4 years have seen something quite extreme happening in European real estate markets. On the one hand, we've seen extremely high prices paid for low risk real estate. In London, in Paris, in Frankfurt, we're seeing cap rates of below 5% for office buildings and cap rates of below 3% for retail property in London. So property being sold for 40 times its rent in Bond Street, and property being sold for 25 times its rent in the West End office market. Very high prices historically. The safe haven effect, the rush for safety in a challenging, risky European market, potentially being challenged by a euro breakup, by declining GDP in Portugal, Spain, Italy, Greece, and this search for quality in the safe haven markets of London, Frankfurt, Paris. And then on the other hand, we've seen value add or opportunistic real estate becoming extremely unpopular in Europe, and cap rates for these assets getting higher and higher to the point where nobody has been buying them. We can get cap rates of over 12% for office buildings in many cities in the Netherlands, for example. There is a high vacancy rate. These are risky buildings, but they are almost certainly too cheap, underpriced. And that money is now starting to target these markets. Leverage is returning to the market. Debt is now available, and people are targeting pretty high returns in these markets. And in that context, we're also not short of opportunities, cheap real estate in very developed markets, but also cheap markets, where Spain, for example, is now being seen as on the start of a rebound. So Spain is now more attractive than it has been for 2 or 3 years. And then we have, in line with the idea that we have leverage coming back, we also have all of these debt funds being launched, more debt funds being launched than equity. So more money being raised to lend against real estate than to invest in it. So the availability of leverage is returning, and it's going to support high-risk investing. So, conclusion from this slide is, core real estate is overpriced. So risk is being over-discounted. People are paying too much for what they perceive as safe assets, and second-class property has been too cheap, and this is where the money will go in the core markets. Okay, so who's investing? Who's providing the money? This is the top 10, the list of the top 10 European investors, as far as I can tell. They don't all tell me exactly what they're doing, so it takes a bit of research, but we think this is what's going on. If we take the Norwegian government pension fund as an example, they have a huge amount of capital, over 500 billion euros to invest, and 5 years ago they decided that they would put 5% of that money into real estate. So 25 billion euros to invest in real estate from a standing start. The first deal they did was in London, the second deal they did was in Paris, the third deal they did was in New York. So they are absolutely following the core real estate path, safe haven markets, high-priced real estate that they think is low risk. And that would be true of pretty much all of these large government pension insurance funds. They're paying high prices for real estate. Now, why are they investing in Paris, New York, London? Part of it is to do with perceived risk, so they're looking for low risk. But the institutional investors' idea of risk is quite complicated. It also includes liquidity. So one big question that the Norwegian government fund thinks about is, where is the liquid market that they can take their money back out again when they need it back out? And this is what we call in English a vicious circle. If there are no investors in the market, the investors will not come to the market because they don't know who they can sell to. And the result is that we have a small number of countries in the world which are institutionally acceptable markets, and another 150 countries which are not. So the money continues to go to the US, the UK, Japan, Australia, and so on. And the prices paid are too high because the markets are too few. And we need to expand the number of markets. Now that slide is these are the investors. These are the people whose money is invested. These are the people who control the money. So these are aggregators of smaller pension funds who manage money across global markets. And you'll see that all of them, every single one, is either European or American, possibly Canadian by origin. Every single one of the world's top 10 fund managers. Now in 10 years' time, I suspect 1 or 2 Asian managers might be in this list. 1 or 2 Middle Eastern managers might be in this list. But for now, it's absolutely dominated by US and London-based organisations, or in AXA's case, French, UBS, Zurich, but the rest are US, UK. These are managing up to $100 billion in real estate. many of them tend to be core investors, so most of those are core focused. Blackstone is not. Blackstone is opportunity focused, and Blackstone is a tremendous example of a big high risk manager. But the rest of them will do core investing. Question that I'm going to ask is how much of the money that these guys manage comes to Turkey? Now this is starting to get towards that answer. This is the origin of the money. So, the countries or the markets that have the most capital to invest in real estate are, the US. And the US pension fund market is huge. This is the growth that we expect over the next 15 years in US pension fund capital going to real estate, followed by Japan. And those two countries are a long way ahead of the next group: Canada, Korea, UK, Malaysia, and so on. How do these guys think about their portfolios, and how do these guys think about their portfolios? Well, here's an example. I've taken a big London-based fund management business which runs 8 billion euros of global real estate. And I'm going to show you their process, how they think about it. Their typical client is a UK pension fund with a 5% real return objective, meaning 5% plus inflation, which in the UK would be around 7% total return. So that's what they're looking for, 5% plus inflation. And they're looking at that through an exposure to developed markets. So developed markets, investing in predominantly in core funds. So this is the classic low risk core investment proposition. First thing to say is that Europe real estate is very attractive because we have planning controls which limit supply. We have long leases which are often indexed to inflation. So if you're looking for a 5% real return and you can buy indexed leases, you're in a very good position to begin with. Basically, you can pay 5% cap rate plus indexation will give you your return target. So it's an attractive market. We will get our US exposure through income-oriented property funds. We have a pretty small universe to invest in because much of the US is higher risk investing. Asia is difficult for a low risk investor. About the only big core market is Japan, which has very high prices. Australia is reasonably attractive, but after that most of the markets are developing markets, so it makes it difficult to invest in. And these investors have little or no exposure to emerging markets, so they will have zero exposure to India, zero exposure to Turkey, unfortunately. Now that may not be a bad thing. We can discuss that. This is the typical allocation. So this investor has a 35% allocation to the Americas, 20% to Asia Pacific, and 45% to its home market of Europe. And then what do we mean by Europe? If we look at the categorization of Europe, and by the way, this is not something that I've advised them to do. I've just taken their strategy from a document. Okay, so this is just observing what they do. And what they do is they define Europe as UK, France, Germany, Spain, Italy, Central Europe, Nordics, Benelux. And unfortunately, or fortunately, whichever way you look at it, Turkey doesn't appear on the pie chart at all. So it's not even in their thoughts. It's not that they've decided to put 0% into Turkey, it's simply not in the strategy to begin with. So there is an issue, there's an issue. Similarly, there's no allocation to Argentina. The definition of the Americas is the US plus a 0% allocation to Canada and a 0% allocation to Brazil. So they're thinking about Canada, they're thinking about Brazil, they've decided not to put any money there, so their only allocations to the Americas is in the US. So these are extremely narrow definitions. And remember, they are influenced by risk, but also by liquidity, because they're wondering, how can I get my money out again? And in all of these markets, they think that there is liquidity. Now, the liquidity comes from two sources. It comes from investors like themselves, so international investors who are globally diversified, but it also comes from local investors, institutional investors, property companies, and those guys probably need some debt. So one of the reasons why there is no money going to Argentina, for example, here, is because there are few, if any, institutional investors in Argentina, because the pension fund system has been nationalized, and there is no banking, there's no working banking system in Argentina either. So local investors can't raise the capital to take out an institutional investor. A healthy market has local investors with equity, local debt, and it starts to become attractive to international investors who can see the liquidity in the market coming from both domestic and international buyers, which is why London, Paris and New York are now attracting so much capital, because they attract so much diversified capital. So, the last piece then, and trying very hard to put Turkey into this picture, the first thing to say is that Turkey is fantastically attractive. It doesn't fit in the processes of investors, but it's fantastically attractive. All of the survey evidence we have points to this. So this is showing the very, very attractive markets in Europe in 2013, and Turkey is the second most attractive market after Sweden. The least attractive markets are in Southern Europe, Italy, Spain. Lots of questions about France. This is how attractive the UK is. This is how attractive Turkey is. But London gets 20 times the investment that Istanbul gets. So, interesting challenge. Where do investors think international investment activity will increase the most? Luxembourg is about that big. It's one town. Turkey is where international investment is expected to increase the most. So, fantastically interesting that people think Turkey is reasonably attractive, very attractive, and is going to attract international capital. In the ULI Emerging Trends survey for 2013, Istanbul was ranked the 4th city in Europe for investment prospects, and 1st in Europe for the expected amount to be invested. So higher than London, higher than Paris, higher than Frankfurt. The economic and demographic potential of the country is fantastic, with half of 75 million people under the age of 29. As Joe said, this compares with Germany, where the average age is 54. The average age is 54. In Italy, where we have a tremendously aging and declining population. Russia, which has an aging, declining population. Turkey is demographically wonderful. So if you are a developer of real estate or an investor in retail real estate or housing, you have this tremendous wave of young people who will spend and buy property and rent property. It's the 6th biggest European economy. Its economic growth is as fast as China's. It ranks as the 3rd most attractive real estate investment destination among the emerging countries, according to the American organization AFIRE. You've got falling bond yields, a big fall recently, which makes real estate more attractive. You've got easing registration restrictions on foreign buyers. Turkey is becoming rated as an investment grade country. you've got more transparency, lots of good things. Some irresistibly good things, incredibly good things. But the transaction volumes in Istanbul are ranked 12th in Europe. It's the first city for attractiveness, but it's the 12th in terms of volume of transactions. And its transaction volumes are less than 5% of the volume of London. So we have a real problem, challenge, question. Why is so little money coming here from overseas if the market is so fantastically attractive? Just to continue to explore this, this is the foreign ownership in the City of London office market since 1970s. In the early 1970s, we saw that the foreign ownership was less than 10%. Now let's say that looks a bit like Istanbul today. I don't know what the number is. I'm not sure whether anybody knows what the number is, but it's probably not a big number. So this may be Istanbul. We then had waves of foreign money coming into London, and we're now above 60% foreign ownership. So the news about London is that it's invested in by global investors, clearly. This is the amount of investment in Turkey as a percentage of all trades from non-Turkish buyers, and it peaked at 7% in 2007. It then collapsed to 0 and is now building back to a very, very, very small number. So again, this conundrum or problem or challenge, why is this? And the case against then, and I think this looks like a wonderful city and it's a fantastically attractive market, but these are what people say are the bad things. First of all, investors, core investors, low risk investors, like markets where there is a strong supply constraint. In other words, where there are limits on development. Turkey is a developing country, therefore you want to build things. Investors would prefer it if there was tremendous limit on building. So that's a problem. This is a survey. The social unrest in Turkey this year didn't help, but then this is slightly ignorant of investors because they forget that London had riots 3 years ago, and there are very few countries that don't have riots. France has riots. So I think the social unrest has been an overstated issue, but people are twitchy about markets in this region, whatever region we're in, by the way, and I'll come back to that in a minute. And that's the problem. The investors that I advise don't know whether Turkey is in Europe, whether it's in Asia, whether it's in the Middle East, or whether it's an emerging market. And the problem there is that because they are top-down allocators, they give money to their European bucket, their American bucket, their Asian bucket. Turkey falls down a crack in between. So people don't know where it is. It sounds crazy, it sounds ignorant, but investors are ignorant. Fourth problem is currency. The Turkish lira has depreciated at the rate of 9% a year against the US dollar for the last 10 years. So that downward drift in currency is a price paid by international investors, and they either take the pain through getting high returns, or they hedge, and if they hedge, it costs them quite a lot of money. And it means, unfortunately, that Turkey becomes a high-risk, high-return market rather than a core low-risk market. And it means you don't get the core investors because their return target is eaten up by currency. What you do get is the opportunistic investors like Blackstone, who will either take the currency risk or will target 20% returns where they can afford some currency depreciation to attack their returns. You know that Istanbul is a developed, vibrant city. Outside investors think that Turkey is an emerging economy. So they're looking for higher returns than you are, which means that they're getting outbid by the local buyers. You still have reasonably high inflation rates compared to Europe and reasonably high bond yields. So whereas bond yields and inflation rates have been falling, which is really good, you still have slightly high inflation and bond yields, which is associated with the currency depreciation. Remember that bond yields in the UK and Germany are around 2.5%. So the margin, the expected inflation and the expected risk in those markets is extremely low right now. And then finally, as I've said, the illiquidity issue, the capital markets don't match the occupier prospects. So you've got a wonderful occupation market, but a more challenging capital market. We need to see more local institutional capital, local debt, and, very importantly, lots of transparency. So international investors take transparency extremely seriously. Jones Lang LaSalle, the global brokerage, run a transparency index, and Turkey is ranked 31st of 97 countries. As you can imagine, the most transparent countries are Australia, the US, Canada, UK. Probably not surprising from an American-British organisation publishing those numbers. But Turkey has work to do. Sitting below Taiwan, Portugal, Brazil, Hungary, it can do better than that given the size of the country. So you need more research, more data, more publications, more meetings like this, more conferences, and all of that will correct this transparency issue. And of course there is lots of foreign investor activity. It may not add up to a huge proportion or a huge number of billions of lira or euros, but there is plenty of activity. So Blackstone has been extremely active. It bought the multi-corporation, and it also bought the Redevco operation last year. I am sad about that because I have been advising Redevco, and a year ago they decided to exit Turkey, and I thought it was the wrong decision. But it's typical of a low-risk German-Dutch high-net-worth family who found the risk of Turkey too high for them to cope with, which is a great shame. Blackstone, high-risk, opportunistic investor, are the natural capital to replace that. But the problem is that Redevco are happy with 7% returns, whereas Blackstone need 15% returns, which means they look for cheap real estate. So it's not good for Turkey. There are funds targeting Turkey in our database, which is very good to see. There are plenty of managers of funds that invest in Turkey. It's just that we need them to be investing more money in Turkey. When more money comes into Turkey, the market becomes more liquid, it becomes lower risk, and then more and more money comes in. And importantly, the core capital comes in. And so I think the challenge for your market is to establish Turkish real estate as a fundamental part of a core Europe strategy for a European or American investor. And that is where we're not yet, but where you would need to be in 10 years' time. In my opinion, having been in Turkey for one day. So thank you for listening. I'd be very happy to answer any questions, or for anybody to attack me verbally, not physically.
Okay. Would you please introduce yourself?
Hello, I'm Frank Roccogrande from BLG Capital. Living in this capital raising market and managing one of the funds here, let me talk about...
Were you on the list?
Yes.
Okay.
One of the other elephants in the room, which is Asian capital, which, and to a larger extent, I think we're starting to see this now from the Koreans starting to make moves in the UK and now in the US. How do you see that changing the landscape of the world being broken up primarily between U.S. endowments and institutions and historically more conservative European institutions?
I think that's a really great question. It's a really good question, and we were having a conversation gentleman from Bahrain on the second row here, we were discussing this issue. My presentation comes from a European perspective because I'm a European. The danger for the European investors is they get beaten by the Asian investors who are more thoughtful about this, and maybe Middle Eastern investors who regard this as part of a regional investment strategy where Turkey is the most attractive market in that region. And so it is perfectly possible that Asian capital and Middle Eastern capital starts to dominate the international capital in this market rather than the American and European capital, which from my perspective is a great shame given the fantastic opportunities. But is that what you had in mind?
Yeah. You know, if you kind of look across the spectrums, and I think the U.S. institutions have been investing the longest. So when you look at the endowments and certain pension plans, you know, when you look at that slide about opportunistic versus core, remember they've been operating these programs much, much longer. You know, so they've naturally gotten further up the risk curve. When you look at European institutions, given what's been going on in Europe, it's not surprising to see most of these guys falling back to core. But I think Asia's coming up on a very fast trajectory. And, you know, they're starting with core now, but where are they going to end up is the question.
As a source of capital, you mean?
Correct.
Yeah, okay. So yes, we're seeing a lot more money coming out of Korea, that's for sure. We're seeing the first signs of Chinese money really going international from the insurance companies and the sovereign wealth funds. And there's Middle Eastern capital. So clearly that is going to become more and more important as a source of capital as time goes on. And I think those markets are going to be more interested in these sorts of markets. The ignorance of the typical European investment plan is something I don't think I would exaggerate. It's I saw one investor recently who have an allocation to Turkey, Ukraine, Russia. So your market is being ranked alongside Ukraine. It's just impossible. It's crazy. Ukraine doesn't exist as an investment location. You know, it's just a huge PR challenge for this industry. You know, it's a huge PR challenge. There's one at the back there.
Given everything you've said about Turkish market as opposed to other global markets, what property types will be most attractive in Turkey? Given the investor preferences, risk preferences, etc., in the upcoming years, and is that going to change in the long term?
Okay, I've got three answers to that. 5 years ago, the answer would have been shopping centres. So, international investors love shopping centres. They tend to overcome a lot of the country-specific issues because a dominant shopping centre tends to be a unique thing to control. The information I have is that there are now a lot of shopping centres. The market is pretty unregulated and therefore a bit risky. Offices are the worst investment in mankind. So nobody should ever invest in offices. You should develop offices and then sell them to some idiot. That's the answer with the offices. Most of the investment market is unfamiliar with residential investment, but is becoming much more familiar with it. And I think residential investment is being drawn into places like China, where you're getting a lot of residential development investment. And then the really emerging sectors, which I think are very powerful, are things like student housing, medical property, senior housing, and I think the opportunity to build pan-global, pan-European, pan-regional portfolios of those assets are pretty attractive right now. My comment about offices, by the way, is to do with the obsolescence of the typical office building. So that as soon as you buy one, somebody else builds a better one, and you find you can't get any rental growth out of the building. That's the challenge with offices. So.
Hakan Kodal from Crea Real Estate. We were co-managers with Big Side on Bosphorus Real Estate Fund, and we have been, let's say, looking for investments for the last, let's say 5-6 years in Turkey. But it's very difficult to get, investment properties, which means cash flow generating assets. So it's more like a development market than any other market. And in a development market, a lot of risks are associated with developments, and gray areas, permits, difficulties of getting out of the ground, which makes lots difficulty on competing with local developers and local investors, and there's huge capital available from locals. So it's very difficult to get investment properties in Turkey. So my question is, taking into account that difficulty, and this is for me a major point why we have very few investors in Turkey. What is the allocation of the current investors around the world on investment properties, cash generating assets, and development assets?
Okay.
And what are the general trends on this? Thank you.
That's a very good question. Thank you for that. The vast majority of real estate capital is allocated to investment real estate. So the definition of core real estate, which is by far the biggest set, is income generating, fully stabilized, high quality tenants. And I think of the world as having two real estate buckets. There's the core investment bucket, and there's the high risk development bucket. So what some people call transitional real estate against stabilized real estate. There is much more money for stabilized real estate than there is for transitional real estate. But in an emerging market, it's quite a good idea to target transitional development real estate, because you're already in that bucket. Because the market is seen as emerging or developing, therefore you may as well be in high risk development, because it's very difficult to get low risk investment property. But it's a small amount of capital, and it's confined to the opportunity funds, who will rape and pillage. They will try very hard to do a hard deal. So I suspect one of the things that are going to be one of the easiest routes to raising capital is going to be a joint venture between a US or European based opportunity fund with a local developer who wants to build in bigger scale. So bigger developments, that will become high quality. And you may even find the co-investor
Vous les femmes, vous le charme, vos sourires nous attirent, nous des âmes. Vous les anges, adorables, et nous sommes nous les hommes.
Tor Gunnan from Cushman & Wakefield. I have a question which I'm not sure if you can answer, but I don't know how much you deal with Russia. But I always struggle to understand why Russia attracts so much more foreign investment than Turkey does. Because all the criteria that you mentioned, low inflation, demographics, transparency, levels of corruption, etc., etc. There are many things to mention. But I think as Turkey we are much ahead of Russia if you look at all these criteria, but still Russia attracts much more foreign investment. I don't know if you have a view on that, or if you will, what would you think is the biggest shortfall for this in Turkey, if you can narrow it down?
It's a really difficult question for me to answer. We did research 3 years ago on the barriers to cross-border investment, and we interviewed 50 institutional investors about what stopped them going into certain markets. And there was a combination of formal barriers, such as bans on foreign owners, or currency controls, or punitive taxation, and the more subtle informal barriers, which are to do with the travel time that you need to expend in order to go to a country to do a deal, or the fact that you can't buy alcohol in that country, or the fact that it's largely Islamic, or the fact that women have no rights. So Saudi Arabia, for example, gets very little foreign investment, despite the fact its demographics are equally fantastic. It's obvious that other countries like Venezuela, Iran aren't going to get any money. Turkey is a challenge. Turkey is a real challenge, because nobody really understands where it sits. Whereas Russia is largely a European country. It's very big, 160 million people. It's almost so big that you can't ignore it. You have to have a Russia strategy. If you talk to the Canadian sovereign wealth funds, they believe they have to have a China strategy. And they have to have an India strategy. Their China strategy projects how big China will be in 20 years' time as a percentage of the global market. And the answer to that is 20%. So they're investing towards having 20% of their real estate in China in 20 years' time. People need to talk about Turkey in the same way. 75 million people, big economy. What's your allocation to Turkey going to be? 1%, 2%, 3%, 4%, 5%. What's the number? And that number needs to be published in benchmarks and pie charts. And then people will bring their money over. Why Russia? I don't know. I've never been to Moscow. I'm going there for the first time next year. I can answer that after that. I don't think I'm going to go to Ukraine.
I guess that's the end. Well, thank you very much, Andrew Baum. Thank you.
Thank you.
And of course,